Welcome. Let's look at question 5 of this anonymous university paper. So we start with question 5a. It requires us to describe the factors that may cause differences between bank statement balances and cash book balance. So what are the factors? The differences may be due to some reasons, and one of the reasons it is some items will appear in the bank statement and not in the cash book. Another factor is that some items will appear in the cash book and not in the bank statement. And also it may be due to errors made when entering amounts either in the cash book or while posting bank transactions. So items that appear in the cash book and do not appear in the bank statement. One is what we call unpresented checks. So what's an unpresented check? An unpresented check is a check that has been issued but has not yet presented to the bank for payment. These checks are issued to creditors or suppliers. Issued to creditors or suppliers for their payment for the goods that they supplied. So they may take a while before presenting the check to the bank, and so the bank will not have the records of this transaction, and this will cause the difference between the two statements. Another item that appears only in the cash book is uncredited checks. What's an uncredited check or uncredited check? You can say these are checks that are received from customers. The customers are making payments, so the company receives the check. So the company deposits the check to the bank, but due to the processes of check clearing that may take some time, the bank statement may be prepared before the bank credits the amount, and this will cause also difference between the two statements. So we look at items that will appear only in the bank statement. One is we have bank charges, bank charges, and we also have standing order, direct credits. So bank charges can be, this happens when the bank debits the account of the business with either bank charges can be checkbook charges, ledger fees, commission, or even interest charged on overdraft or on loans. Next is standing orders. Standing orders are also known as direct debits. These are automatic payments or deduction of amount from the bank account of the customer to pay some loans. Next is direct credits. Direct credit, this is when a customer pays directly to the bank without informing the business. So the bank will record the transaction, but the accountant will not record it in the cash book. We also have interest and can be interest either earned or paid. Interest earned, when the business earns an interest, it will appear in the bank statement, but not in the cash book, and that will cause the differences. And we also have the errors made when entering and recording transactions in the cash book. The errors may be overstatement, and understatements. Overstating and understating of receipts and payments. Another error made when entering amounts in the cash book can be misposting deposits and receipts, deposits and payment, or deposit and receipts. Another error made when entering amount in the cash book can be overcasting or undercasting the balance carried down in the cash book. So we move to question 5b. Question 5b says accounting has developed over the years as a field of studies. Distinguish between any two of the main branches of this field of study. So first of all, what are these two main branches of accounting? We have so many branches of accounting. You can name them. We have financial accounting, management accounting, auditing, taxation, and so on. But what are these two main? So the two main branches are financial accounting and management accounting. So this question basically requires us to state the differences between financial accounting and management accounting. Management accounting can also be referred to as cost accounting. So what are the differences between the two? One, you can say that the users of financial accounting information are external users. Financial accounting is meant for external use. What are the external users? These are investors. They have creditors, the government or government agencies like the revenue collection agencies, that the Kenya Revenue Authority, and also the general public. On the other hand, management accounting is for internal use. That's the management of a company. Another difference is that financial accounting is statutory. It is required by law. It is required that every company must prepare financial statements at the end of every financial period. So it's compulsory. On the other hand, management accounting is not compulsory. Another difference between the two is that financial accounting is done periodically. It is periodic. This means that financial reports are prepared either annually or semi-annually or even quarterly. But management accounting reports are prepared frequently. Another difference is that in financial accounting, it involves preparation of financial statements. Preparation of financial statements. Financial statements. What are financial statements? Financial examples of financial statements. Financial statements have income. We have the income statement. We have the statement of financial position, and we have also cash flow. The cash flow statement. But management accounting involves preparation of internal reports. Internal reports such as job cost sheets. Another difference is that financial accounting is historic in nature. Financial accounting is historic in nature. It provides information that has already happened, and therefore it gives a glimpse of the company's financial position over a given period of time. But management accounting is futuristic. It focuses on providing information for future use. That's for decision making, either short term or long term. Another difference is that financial accounting conforms to a standardized format of reporting. It must conform to the generally accepted accounting principles and even international financial reporting standards. This to ensure that the reports or the financial statements are consistent and comparable in reporting across different organizations. On the other hand, management accounting does not conform to any standardized format or any principle. Reports are tailored to meet the specific needs of the company. I think that's all. Those are some differences of financial accounting and management accounting. Said financial accounting is meant for external users, while management accounting for internal. Financial accounting is statutory. Management accounting is not compulsory. Financial accounting reports are prepared periodically. That's either annually, semi-annually, or quarterly. But management accounting reports are prepared frequently. Financial accounting involves preparation of financial statements. Those are income statement, statement of financial position, and statement of cash flows. But management accounting involves preparation of internal reports like job cost sheets. Financial accounting is historic in nature. It provides information that has already happened, but management accounting is futuristic. Then financial accounting adheres to generally accepted accounting principles and international financial reporting standards. On the other hand, management accounting does not follow any standardized format when preparing its reports. So we move to the last part of this question, which requires us to describe the role of accounting in the society. So basically, the main purpose of accounting is to provide financial information to help in decision making. That's one role of accounting in the society. So we can say that accounting provides knowledge needed to manage financial resources effectively. It provides knowledge needed to manage financial resources effectively, and we can say that accounting also ensures financial transactions are conducted accurately and in a transparent way. So we can say that it builds confidence. It builds confidence and trust in investors. By providing accurate and transparent financial reports, since investors rely on those reports to assess potential risks and return of an investment. So that accounting also helps in resource allocation. That's through budgeting and financial analysis. It helps the business to determine where to invest. That is a project that is economically viable, and it also helps the business to optimize their spending. Accounting also, it helps the government to collect revenue, that is taxation, or we can say it ensures statutory compliance. Accounting ensures statutory compliance, that is calculation and reporting of taxes, or you can say tax remittance. So it helps the businesses to ensure they meet their obligation, or they fulfill their tax obligation and comply with the tax laws. And in the process, it helps the government to collect revenue and economic planning. Another role of accounting is that accounting helps the government to plan for the economic planning and policy formulation. Say the government relies on accounting data for economic planning and policy formulation, and also to assess the performance of the economy or the health of the economy by looking into the national income account and so on and so forth. So that's all, and thank you.